What is underwriting? Underwriting is the process of evaluating the risk associated with lending money to a borrower applying for a mortgage, home loan. The lender assesses the borrower's ability and likelihood to repay the loan by examining 4 key factors, commonly known as the 4 C's of underwriting. The 4 C's of underwriting. 1. Credit. Refers to the borrower's existing debt and credit history. Lenders evaluate the borrower's credit score and liabilities to determine repayment behavior and risk level. 2. Capital. This is the amount of money the borrower contributes towards the home purchase, also known as the down payment. 3. Collateral. The value of the property being purchased or refinanced. It serves as security for the loan. In the event of default, the lender may sell the property to recover the loan. 4. Capacity. The borrower's income and ability to repay the loan. Lenders assess this through income documentation and compare it against existing debts. Generally, a borrower can qualify for a loan amount where total housing expenses do not exceed 50% of their gross income. Types of mortgage transactions. 1. Purchase. 2. Refinance. 1. Purchase. Purchase transaction occurs when the borrower is buying a new property, which could be primary residence, the home where the borrower intends to live for at least 1 year. Expenses for this property are considered primary expenses. Secondary residence, a vacation or second home used occasionally. It must be suitable for year-round occupancy, but cannot be rented out. Example: a borrower living and working in California buys a vacation home in Florida. The Florida home is a secondary residence, and related expenses are considered proposed expenses, while the California home expenses are primary expenses. Investment property. A property purchased to generate rental income. Expenses on investment properties are also considered proposed expenses. 2. Refinance. A refinance occurs when a borrower already owns a property and wants to replace the existing mortgage with a new one. Types include cash-out refinance. The borrower takes a loan against the property's equity for any purpose, including paying off debt or obtaining cash. There is no limit to the amount of cash that can be taken out. Limited cash-out refinance. The borrower refinances the mortgage only to lower interest rates or monthly payments, without withdrawing any equity from the property. Types of mortgages. 1. Primary mortgage. The first lien on the property. In the event of default or foreclosure, this mortgage is paid first from the sale proceeds. 2. Secondary mortgage. A second lien, typically used for down payment assistance. This is subordinate to the primary mortgage and requires a subordination agreement. 3. HCLTV, home equity line of credit, a revolving line of credit based on the property's equity. It functions like a credit card. Borrowers can draw from and repay funds within a set limit. Example: a borrower with a $100,000 HCLTV draws $25,000. The available balance becomes $75,000. After repaying the $25,000, the available balance returns to $100,000. HELOCs are usually subordinate to the primary mortgage. Key financial ratios. 1. Income to expense ratios. HTI, housing to income ratio, calculated as proposed housing expense, gross monthly income. Examples: borrower with $5,000 gross monthly income and proposed housing expense of $1,000. HTI equals 1,000 5,000 equals 20%. If a borrower already pays $500 in rent, soon replaced by the new housing expense, only the proposed housing expense is considered. HTI equals 1,000 5,000 equals 20%. If the borrower owns a primary home with $500 expense and is buying a second home with $1,000 proposed expense, HTI equals 500 plus 1,000, 5,000 equals 30%. DTI, debt to income ratio, calculated as total monthly debt plus housing expenses, gross monthly income. Examples: borrower with $500 in credit card debt and $1,000 proposed housing expense. DTI equals 500 plus 1,000, 5,000 equals 30%. Borrower with $500 in debt, $700 existing second mortgage, and $1,000 proposed new expense. DTI equals 500 plus 700 plus 1,000, 5,000 equals 44%. Note: Lenders use the gross income, before taxes or deductions, from up to 4 applicants on a mortgage application to determine these ratios. 2. Property value ratios. LTV, loan-to-value ratio, loan amount, lower of purchase price or appraised value times 100, CLTV, combined loan-to-value ratio, primary loan plus secondary loan, lower of purchase price or appraised value times 100, HCLTV, home equity combined loan-to-value ratio, primary loan plus HELOC credit line drawn, lower of purchase price or appraised value times 100. Examples. LTV. Loan, $100,000, purchase, appraised value, $500, 000 LTV equals 100,000 500,000 equals 20%, CLTV. Primary loan, $100,000, second mortgage, $50,000, value, $500, 000 CLTV equals 100,000 plus 50,000, 500,000 equals 30%. HCLTV. Primary loan, $100,000, HELOC limit, $50,000, amount drawn, $25,000. HCLTV equals 100,000 plus 25,000, 500,000 equals 25%.